Hey, YouTube. How's it going? Hopefully your trading's going well, as always. Just back with another quick video. We were just discussing the VIX and how to use the current price divided by 16 to compute an average daily expected move, a minimum move size. If the markets are extra volatile, it'll be a larger move, obviously, and so you can't rely on it 100%, but you can use it within a reasonable estimation. Um, but here, this is a little continuation on the VIX, and just wanted to do a quick video because the VIX is in a unique spot. The markets are in a unique spot. Um, and they appear to be primed for a move, a decent move. Um, Unfortunately, the only way to know if it's real is to wait it out and see what happens. Because, as you know, breakouts can be false and come right back to breakout price. And that's typically usually what you get when price moves outside trend lines. Like here, this spike up, tried to break out, came back down here, tried to break downside, came back. But this is where it helps to know general consolidation patterns, which you can learn in the CMT study materials. Highly recommend level 1. Will change the way you trade. Even if you're just like a retail trader trying to make extra money, you're not a professional. It's not um, it's not a very dense read. There's a lot of pictures and illustrations, etc. They um, quote and give books and information from notable professional traders. You also learn their strategies. So if you don't want to come up with your own, see, the idea of the CMT is that they train you what you need to do so that you can build from scratch your own timing model and time the market and trade however you want to trade on whatever time frame you want. It gives you the skills to do that. And so if you don't want to do that, they also tell you about they give you names of plenty of professional traders. You can go to their websites, you can read their books. They can tell you if they've developed a specific strategy because it will have an official name. You can go probably learn that strategy for free online somewhere, but you could probably go to their website too. They probably have books, etc. And so if you don't want to have to derive your own system from scratch, it'll help to learn the fundamentals so that you can watch a chart live as trading occurs and be able to know what's going on. And you won't have to build anything from scratch. But anyway, back to the VIX. So just discussing on how to essentially take the current price divided by 16 for an average expected daily move, or divide the current price by the square root of 12 for an expected monthly move, which to me is less reliable than the daily because it's the VIX and it's volatility. It's not a trending security. It's not an equity market, commodity, etc., that each have a reasonable, predictable behavior pattern. The nature of volatility is just that. You can't predict it. It's not predictable. Doesn't have any other nature except it's wild. It's crazy. And so the only way that I really feel comfortable using the VIX is to treat it like I would any security in terms of charting. Look for patterns, have multiple indicators set up, and use them to analyze the market in its full context, Not just looking at one thing like price, not just looking at one thing like volume and saying, oh, there's a lot of volume, so I'll, go long. No, no. We do confirmations. We look for 2-bar confirmations. This actually has a 3-bar confirmation. As you can see, this bar closed lower than even the prior bar range, the bottom of the range, not just the close. But when you have continuous closes lower like this, it's a directional indication. And the higher you go on the time frames, like if you had 3 bars like this on a monthly, that monthly activity is so much activity, like there's so much trading in a month. To have that pattern show up on a high time frame shows you that somebody with money, or multiple people with money, are confident that the market's going to go a certain way, and they're willing to commit their money. And so that is reliable data. That's what you want to see. But you don't want to just go off price. And here's why. You've got a 3-bar here, hits the bottom of the trend line. But look at where the CCI is. Right? It's like barely hitting the 0 line. Not very convincing. The directional index is still extremely bullish. Not even close to crossing. The momentum, while decreasing, is still bullish. So it's not really like you're not looking at this. The only thing the CCI here says is that, okay, the bullish might be over. And if you're long here, if you got in long here on the real move, you need to sell. So now it's too risky. It could change sentiment and go bearish. But then also it helps to know consolidation patterns, because you can see here very clearly it's in a broadening consolidation pattern. And so on the first touch of a trend line in a consolidation pattern, it's not necessarily going to break out. Like it usually goes a couple, 2, 3, right? Like here on the third one, everything lines up. Okay, it usually takes a couple for the consolidation to, everybody's making bets. The price discovery is happening. The bulls and the bears are fighting. Somebody's going to get control. And there's lots of little clues. So here you have a squeeze, right? And then you have a solid move upside. The DI index is strongly bullish. The bearish isn't even close. There's not much volatility though, so the move isn't extremely huge. I mean, it's a decent move, but it doesn't have enough volatility to keep going up more. And so it starts to consolidate. And so what you have then is a move downside, but it's actually a partial. It doesn't actually come to the bottom of the trend line. It actually is a partial, which suggests it's going to break out upside. Now, a partial would also be equivalent to, like, if you're a Fibonacci trader, you'll understand this, but it's a throwback, like a halfway back, a 50% retracement before going long again. And so it's a partial, and so that suggests it's going to go long again, which it tried to do, but then failed. Then it came back to the bottom of the trend line. It pierced it and failed. Didn't have anything else going for it, really. Directional bias, no. Volatility, no. Momentum's bullish still. The CCI did go break into the blue, but it's still above 0, so it's not necessarily bearish. It's just saying, hey, if you're long, you should sell. Take your profit. It could go bearish. Then it comes back. It's continuing to consolidate back up to the top of the trend line, then back down. and then another partial upside, which suggests it's going to break downside. And so now we're back down towards the bottom of the trend. But the context of the market is completely different than all the rest. And why is that? Well, you have a bunch of confirmations. You have a solid 3-bar move, which you've seen before, but now this time you've got a squeeze going. The momentum has turned bearish, although it's not a lot. It's not strong momentum, but it's still in a squeeze. The momentum will build once the squeeze fires. You've got the directional indexes converging, attempting to cross. There's a little bit of extra volatility. It's above 20. Ideally, you want 40, so it's not crazy volatile, but it's there. So if the momentum and the volatility increase because people see this and start placing bets, then that squeeze could trigger and fire short side pretty solid. But here's the final piece. The CCI is finally breaking downside out of the blue. And so that right there is signal generation to get you in the trade early. And if the breakout is real, the squeeze fires, the DI crosses, volatility increases, you can catch a really nice move downside. If it's not real, then it's no big deal because you have risk management in place. You either have a stop in place, once you short it, you're going to have a stop in place for either the exact price you bought in or maybe the top of the bar here. Something very tight. You don't want the market to move against you, really. You can always buy back in short, or rather sell back in short, but you want to have tight management, risk management. But this right here is how to use confirmations to predict a move. Now, you have to watch the charts because it's all about timing. That's trading, whether it's long-term or short-term. You need to time it so that you get in at a good price and you get out at a good price. That's the name of the game. And how to do that is to recognize consolidation patterns, what they are, what they mean. The broadening means poor performance, so it's not surprising that this is going to move downside, especially with a partial upside and back down to the bottom with a squeeze, bearish momentum. The directional index is trying to cross, a little bit of volatility in there, and then finally cash flow, the CCI, is trying to break out downside as well. So cash flow is continuing to move out of the market. So sell pressure will increase if it's real. And so you can't really tell if it's real until the trade completes, but that's why you have tight stops, good risk management. So that's it. That's all I wanted to show you. Let's see what happens here. I expect some more move downside, possibly a move back up into the trend line to break out price, and then the real move downside. That's very possible if it doesn't go initially in one swoop. That's very common. That's why it's on you as a trader to decide what your risk management is. Price will often come back to breakout price just because the initial move is volatile, and in the short term, dealers need to hedge their losses. So as price is going down, they're going to buy to offset that. And so what happens is price tends to come right back. But if the move is real, that either won't happen because the downside pressure is too great, or it will happen, but the move is real anyway, That's the way the market wants to go, and so it will happen eventually. And so that's why it's not uncommon for it to come back to breakout price and then move downside again. And that's when the real move happens. And so you just got to look at the context of the market. Hopefully this squeeze ends here in the next bar or so and fires and you get a good move. In terms of predicting the size of the move, the CMT method is essentially to use the base. So the base here would be about this size. So that is another reason that broadening patterns aren't ideal, and they are considered decreased performers because they are broadening. And so because consolidation gets wider, it eats into the breakout versus like a converging triangle pattern that converges tighter and tighter. When it breaks out, it's going to be at the tightest part of the triangle, and so there's a lot of extra room for the breakout, whereas the broadening, it's getting wider and wider, but it's still in the consolidation, but it's eating into that breakout range. So it's considered a lower performer. But if you know what you're doing, you can still make money. It just won't be as much. Um, but yeah, so here's about an expected move here, 1859. But uh, I will keep this up. We will see what happens here in the next coming week or two. Um, and we will test this, the validity of this method. And if the data that we're seeing is reliable here. And so if it's not, then we can't trade on it because that's no good. So, but that's it. Um, let's see what happens. All right. So, like, subscribe, leave some comments, questions, whatever, facilitate discussion. We'd love to know your thoughts. Try to answer any questions you have, etc. But just looking to get some conversation going. Feel free to chime in your criticisms if you think this is crazy or whatever. Doesn't matter. Um, just looking to facilitate some discussion. So looking forward to talking to you and good luck with your trading. Take care.